Okay, I'm Kose John from NYU, and I want to welcome you all to the session on DeFi versus CeFi. And I appreciate you coming in large numbers, even though it's the last day of the program and all that. So let me introduce the panelists. We have a great panel. So Fahad Saleh, he is the Associate Professor of Finance and Nunnenkamp-Cinelli Faculty Fellow at Wake Forest University. That's Fahad. And then we have Joel Hasbrouck, who's my colleague. He's the Kenneth G. Langone Professor of Business and Professor of Finance at NYU Stern. Quentin Vandeweyer, who is Assistant Professor at the University of Chicago Booth School. Joshua White, Assistant Professor of Finance, and Brownlee O. Currey, Junior Dean's Faculty Fellow at Vanderbilt, Owen School. Okay, so we have a great panel. Now, in a session like this, many times you get into a conversation about some new DeFi. And then, half the time you realize, people are thinking about different things when they say DeFi, So, but from this year forward, whenever you talk about DeFi, I want you to be exactly specific and precise about it. And so Fahad is going to sort of launch into it, and then I'm going to give you the lay of the land for our session. Fahad.
Thank you, Kose. So before you commit your 90 minutes to this session, we thought that we should clarify what you're actually going to, hopefully learn about here. And so the session is entitled DeFi versus CeFi. Our working assumption is that the people at this conference are fairly familiar with CeFi, centralized finance. That's just the finance as, people normally think of it. And so maybe though at the top here, it requires some clarification, as Kose was saying, on what exactly DeFi is, because it gets thrown out a lot. And you might wonder, is this just some, buzzword or something like that? Or is there actually some sort of, technical meaning that it has, that is going to, by the way, go across all the presenters that we have here today. And so the answer is that the term decentralized finance actually has a very sort of precise technical meaning. And at the simplest level, all it really is when you are providing financial services through a blockchain. So instead of implementing it in, let's say, the traditional ways through traditional centralized institutions, you're implementing it through a blockchain. And when you hear that, though, you might wonder, well, okay, so if it's providing the same sorts of financial activities, why do we need the blockchain? Like, what is the actual benefit? Fine, there's a technical definition that when you're doing these financial activities, you happen to be doing them on a blockchain, but why bother in the first place, right? Why don't we just do them the way we normally do them? And the usual argument here is basically that the blockchain is able to facilitate a certain commitment, and in this case, commitment to, for example, pricing schedules, right? So we're going to hear in the first presentation about decentralized exchanges from Joel Hasbrouck. And so in that case, what's happening is it's a trading exchange. So people are trading assets and so on, just like they would in a centralized exchange. But there's a commitment to a pricing policy. There's a commitment to a fee schedule, which wouldn't exist in a centralized setting. And for example, in the second presentation, we're going to see Quentin Vandeweyer talk about lending platforms, so borrowing and lending. But the difference here again is that there's a commitment to the interest rate setting policy, which of course is not there in traditional settings. So the key thing to think about when we talk about decentralized finance is because it's implemented on the blockchain, you're able to commit to certain pricing schedules that may not have been incentive compatible, and therefore you wouldn't have been able to commit to in a traditional finance context. Now, this all sounds great, but in economics, of course, we like trade-offs, and fortunately enough, there is a trade-off. It's not all upside. There are downsides to committing to pricing schedules, for example, which is that the set of things that you can commit to are actually limited due to a friction that's sometimes referred to as the Oracle problem. But at a high level here, the point is the blockchain can't access all public information. And so that restricts what you can commit to. And so that can, of course, create certain issues. And just to give you a high-level example, for example, you might think that, whether you want to lend at a certain interest rate should be related to, for example, what the front-end interest rate on treasuries are. but the blockchain doesn't know what that is. So it can't, for example, choose its policy on that basis, right? And so when you think about the potential upside here of being able to commit to policies that might be favorable to consumers that you wouldn't have been able to commit to otherwise, but then the downside of the fact that the set of policies you can commit to are constrained, you realize then there's an important trade-off here, and that sort of is what motivates this session. It's not clear from, without doing some further analysis, let's say, what actually is sort of better, centralized finance or decentralized finance. And so we're hoping to get sort of a critical take on a number of aspects in the decentralized finance universe to help us think about the trade-offs more carefully. So with that, Kose, why don't I turn it back over to you, and you can maybe lay out the session outline.
Yes. So Fahad, thank you. We're going to focus on three aspects of the DeFi versus CeFi. The first, Joel Hasbrouck is going to start talking about decentralized exchanges. You know, what are the mechanics? How are they actually different from the centralized exchanges, the regular traditional exchanges? So that's Joel. He has 20 minutes, and hopefully we have some time for Q&A after that. The second presenter is Quentin. Quentin is going to talk about lending platforms, decentralized lending platforms. Again, he's going to tell us the mechanics of these lending platforms. And of course, what we all want to know is how is it different from traditional banking, shadow banking, and things like that. So Quentin is going to do that. And last, Joshua White. He's going to talk about probably one of the most important topics in this terrain. A lot of people, ask me, so what do you think? Where is this blockchain thing going? And my answer is, literally, it depends on clever, imaginative regulation of the terrain. That is, you have to regulate it, but you don't over-regulate it. And of course, many times when you talk to law school law people, they don't seem to be having a very clear idea about what exactly is to regulate the space. But Josh is going to clarify it all. So he's going to talk about the lay of the land in regulating decentralized platforms, decentralized systems. Also talk about the issues of contrasting that with the traditional regulation, of securities and markets and things like that. Okay, so each speaker is going to take, let's say, 20 minutes. It's a soft deadline. After that, we'll have some time for questions, and then we'll go on to the next speaker. Joel?
Hi. I'm going to talk about certain aspects of automated market makers and our usual limit order books. Now, I'm going to be talking about liquidity, which I see there are probably about 35 people here. You probably each have your own favorite definition. I just want a quick working definition, the ability to sell or buy a large quantity quickly with small price displacement. And liquidity, we view it as something that can be produced and something that can certainly be consumed. And I'm going to look at these two competing mechanisms. I don't know as it's versus. I think they can both win. I think they can operate in parallel. But what I'm going to try and convince you of is that from a liquidity demander's viewpoint, the automated market maker can look pretty much like a conventional limit order book. On the supply side, though, they are night and day. So I'm going to be using this as an extended example. I've left the web link in there because this is a great source of teaching material for students. You can show them a limit order book live, and if this were a weekday and we were loading it on the web, we would see the prices changing. Now, it's organized, and this is a screenshot, it's organized with prices low to high, the bids, the buy orders at the bottom, and the sell orders at the top. The most aggressive bid is 908. Robinhood is offered at 909. And these are just the top 5 levels of one order book. To keep things within my 20-minute talk, I'm going to ignore deeper levels, and I'm also going to not talk about other limit order books in this market. All right. So I'm going to assume that this is the book, but remember that we're only seeing a partial picture here. So those prices, I'm going to graph them for visualization. So price is on the vertical, and on the horizontal axis is the quantity of the incoming order in shares. So in red, I have ranked the top 5 limit orders with their horizontal expanse indicating how much there is at that price point. And then in blue are the bids. 0 is sort of right in the middle. And if we get an order for, say, 5,000 shares to buy, it's going to start working its way through this book. Now, I want to focus in on what's going to be an important point, the gap between the bid and the ask side. The midpoint between the two is $9, 8.5 cents. The spread is 1 penny, and we can think of this as the round-trip cost for buying and selling one share. In basis points, so the one-way cost is 0.5 cent, which for this stock works out to about 5.5 basis points. Now, what I want to do is build an AMM that is going to match as closely as possible that limit order book. And to do it, I'm going to be working in a slightly different framework. But I do want to emphasize that in many respects, they are really similar. Whether we are talking about a traditional stock exchange like the NYSE or an AMM, they are defined by their rules and procedure. You know, we used to think of the exchange as the granite building at the corner of Wall and Broad. Now we think of it as the rule book, which could be implemented just about anywhere. Same thing for an AMM. And also it's important that at this point, both of them are ultimately implemented in computer code. They're different, of course, and the economic differences are going to mirror the differences in their trading protocols. The New York Stock Exchange, it goes back to 1792. For many years, it was the 800-pound gorilla among U.S. equities exchanges. Now it's still important, but less so. To draw a correspondence in automated market making, a similar dominant institution would be Uniswap. This is the NYSE's rule book. You can go to the Uniswap website and see theirs. Now, Uniswap has defined over the years various protocols for automatic market making. The first one was version 1, version 2, version 3. Version 4 is on the drawing boards, but I don't know if it's been formally released yet. But it's not there yet, at least not in common use. V2 and V3 are in active use, And this presentation is going to rely on V2. So what are some of the costs involved? Another screenshot of the Uniswap V2 documentation. Liquidity providers earn a 0.3% fee, right? Now, that is 30 basis points, proportional to their share of the pool. And in this literature, the fees turn out to be very important because the automatic market makers by themselves have the unfortunate property that they tend to lose money. So to get people to participate in liquidity provision, we do need to give them some kind of revenue, and this is charged to the liquidity demanders in the form of a fee. For a V2 AMM, that fee is 30 basis points. So, ignoring that fee for a moment, AMM pricing functions are continuous. The limit order book that you see here has a rather big gap. So the first thing I'm going to do is bridge that gap to make it comparable to an AMM, I'm going to add the half spread to all the bids and subtract the half spread from all the asks. Now we have a continuous price schedule centered around the original bid-ask midpoint. So here is the book recentered and adjusted. And here is an AMM corresponding price curve. We can treat it as, intuitively, it's the same thing as that limit order schedule. It is centered around the current price, and if we buy or if we sell, we move up the curve or down the curve. Now, fit here is in quotes. I could have done an optimized fit of some sort, but as it happens, I just picked some parameters to get a good visual match. Now, those two functions, the book and the AMM pricing function, they're not exactly the same, but boy, to a good approximation, they are very similar. On that observation rests my contention that the limit order book and the AMM can look very similar to the liquidity demanders. So, exactly how was that green line constructed? Well, my notation here is going to follow Andreas Park and Katya Malinova very closely. It's easy to follow. I recommend the article to you, or the working paper now. And underlying the AMM is a liquidity pool. Liquidity pool is a portfolio consisting of whatever we're trying to trade, shares, and cash. So, for example, if a pool has 1,000 shares of Robinhood and $90,850 in cash, the marginal price implied by that portfolio is, well, what we've taken as the market price, the midpoint of the limit order book. Now, at the dawn of this thing, the AMM is empty. The initial investor is going to deposit C&A to the pool. Over time, they can make additional deposits anybody can make additional deposits, or they can withdraw. The best fit pricing function that I superimposed on the book, that happened to arise from having 4 million shares of Hood and about $36 million with a total value of about $72 million. That is sort of the pot, the pool that is backing our promise of liquidity. How does that compare to the book? Well, the book has 9,000 shares available. The bid side is looking for about another 9,000. If we were going to sweep either side of that book, we would pay or receive, if we're on the ask side, $81,000. Now, the point here is that even though the demand schedules look, or the pricing functions look very similar, there is a world of difference in the scale. The AMM wants $72 million of cash and stock. The limit order book is comfortable with, let's say, $100,000. Why? Well, the pool's investors in the AMM, they earn compensation from supplying liquidity, from the fees, but they also bear risk. As with any market maker, an adverse price movement can catch them flat-footed. The pool is defined by what is called a liquidity function. It's going to be increasing in shares and cash, and in a V2 pool, the function has a particularly simple form. It's the product of the cash and the number of shares. And an investor in the pool can create or withdraw liquidity. When they do that, they change the size of the pool and the amount of the liquidity available. So by varying L, we can approximately match what's called the slope of the limit order book. All right. Now, here are the algebra of these things, because it's constant product, is not complicated. I'm not going to work through these in detail, of course, but I want to point out one important feature of the way this pool operates. There's a principle called liquidity invariance, which is invoked here, and it refers to the assumption that ordinary trades do not change the total amount of liquidity. So as we buy or sell shares, we're certainly changing the quantities, but we're not changing the product. This invariance gives us average prices, marginal prices, and the price curvature. So let's see here. For the original limit order book, the $72 million pool gives me the green line that matches pretty closely the slope of the limit order book. Now, did that just happen by accident? Of course not. I had to play around a bit with the number of shares and the amount of cash. But exactly how sensitive is the green line to the size of the pool. If I cut the size of the pool down to a quarter of this, it looks very different. This is what less liquidity looks like. For a given quantity, this steeper line is going to move the prices far more. I want to point something else out. The limit order book, if I start at 908 and go up 10 cents and down 10 cents, that's it. I've exhausted the Robinhood book. But the principle of the AMM is that they have to be ready to provide liquidity at all potential prices for all potential incoming quantities. So if I look at that last picture and say, you know, I'm not really interested in 5,000 shares, I'm interested in something like 20 or 40,000 shares, then sort of we have to zoom back on this diagram. And once we've done this, we see that the AMM just keeps going. It can offer liquidity for 20,000, 40,000, and on and on and on, when the limit order book just spans a very tiny portion of that curve. Now, this observation, it's an important one because it motivated a transition. This is, as I said, a version 2 automatic market maker, and it was noted when people started using them that there was an awful lot of liquidity in this pool that was probably never going to be touched. The reason that pool has so much value locked in it is that it has to be able to provide an incredible level of liquidity at all kinds of prices. V3 changed that. It broke the price axis down to a set of much smaller intervals, and within each of those smaller intervals, we have a constant product function, but we no longer have one function by one investor that spans the entire space. Now, so an AMM can match the demand curve or the pricing function on the book. It can provide the book's liquidity and a good deal more. But there are some fundamental differences. So a book is maintained in price time priority. If an order comes in for 5,000 shares to buy, it will march up that red line. An order at a given price, orders will execute first come, first served. In an AMM, what's happening looks similar in that if we send an order into this green line, we will march up along the line or we will march down. But that's about as far as the comparison sticks, because any executions in the AMM are not going to be in any kind of price time priority. They will be pro rata against the entire pool. And that has ramifications, as we will see, for how they are used. So let's take an order. This is an order buy 8,834 shares that is said to sweep the book. It takes out everything on the ask side.
So Joel?
Yes. Thank you, Kose. So it goes right up this step. And the thing about a book is execution removes the order. So in a limit order book, if these orders have been executed and a sell order comes in, it's going to immediately start hitting not the marginal price of the last ask order. It's going to immediately start going through the best bid. In an AMM, the price is working up the green line, leaving the last price right there. If a buy order then comes in, we're going to start from here, working our way down the green line. There's none of this jumping to the bid side. And that is very different. So in a limit order book, we think of a limit order as providing liquidity to people who want to buy or who want to sell, depending on whether we've put in a bid or an ask. This is providing liquidity in both directions. It's a market maker who really never leaves. They will buy if we need them to buy, sell if we need them to sell. Now, this alters our perception of the market in a way that we haven't seen in a while. Because really up to the beginning of this century, if we looked at the institutions and the academic work, it was pretty much based on models that had liquidity suppliers and liquidity demanders and a sharp dichotomy between the two. But when markets got fast, the traditional market makers were displaced by what were called de facto market makers, the high-frequency traders. And the thing about the HFTs is that they did not stick to one strategy or the other. They used a mix. Sometimes they'd be providing liquidity, sometimes taking it. And nowadays, traditional customers, both retail and institutional, also do a mix. And the question is, do AMMs have that flexibility to switch from being a liquidity provider to a liquidity demander? Well, yes and no. So if I deposit to or withdraw from a liquidity pool, that's an ordinary transaction. It's not like canceling an order on a book. As an ordinary transaction, it incurs gas fees, price risk, a delay. Now, these gas fees are small, but when there are multiple pools, Lahar Parlor and Zoikin show that these gas fees can induce strong segmentation and clientele effects. So they can really affect the overall market structure. In a limit order book, a trader might use a very aggressive order not to provide liquidity, but rather to provoke a potential counterparty into executing. Right? You know, that price is just too good for me to pass up. So I reach out and I execute. in an AMM, we can't selectively make our liquidity more aggressive, pro rata. Everything is pro rata. And you know what? Good time to stop.
Thank you, Joe. Quentin is going to talk about lending protocols, DeFi lending.
Okay, so thanks a lot, Kose and Fahad, for inviting me to be in this panel. So I'm really honored, and I've been tasked to talk about DeFi lending, and I'll try to highlight what are the differences between traditional finance lending, different markets, and DeFi lending. So just a bit of a roadmap for the talk. So I'll start with trying to provide a bit of a primer on what DeFi lending actually is. Here I'm going to use the working definition, I guess. Thinking about DeFi lending as being some form of automatized lending markets with pre-programmed or pre-committed, as Fahad said earlier, pricing mechanism. I'll provide some details about exactly what these are. After that, I'll ask and try to discuss what are the main challenges that DeFi lending platforms have to solve. And for this part, I'm going to argue that these challenges are very similar to the challenges that banks or other institutions that are in the lending business have to face, but they're like somewhat different solutions to that. And we'll see that, especially think about the design of this algorithmic pricing mechanism, you have to trade off between stability, efficiency, and liquidity. And for this part, I'm going to draw from a joint work that I have ongoing with Fahad and Thomas Rivera. But I should say I'm going to speculate a little bit beyond what we do. So if you are angry about something I say, it's my fault or not, therefore. And then after that, I'm going to end with like trying to think a little bit about how are these DeFi lending platforms used in practice today. And here I'm going to argue that, for now at least, they're really used in a similar way as repo would be used in traditional finance. And in that sense, it's going to be mostly, what I think is a market completeness device that are going to allow agents with like different risk tolerance or different optimism or pessimism to different assets or beliefs to take positions in a larger extent than they would otherwise by taking leverage or shorting. Okay, so let's start with the primer on DeFi lending. So I think the main the main angle, think about what DeFi lending could do to traditional finance would be basically think about the fact that most of lending markets are actually nowadays intermediated by some intermediary, like an intermediary. And that intermediary is taking some fees for doing this intermediation. And now we're going to try to replace this intermediary by directly some smart contracts. So what are possibly the benefits of doing something like this? Well, one that we know that banking is a high barriers to entry, high margin business. So there might be some gains if just making the banking sector or the banking business, lending business more competitive and reducing rents. The second benefit we might see is that it's also a business really highly labor intensive. So there might be ways of like automatizing a lot of tasks and therefore achieving some productivity gains. Just have to be careful about something, and Josh is going probably to talk about more that later, is that a lot of the reason why banking is labor intensive is because there's a lot of regulation on banking. And that takes a lot of labor to do. So there might be some sort of regulatory arbitrage we need to think about as well. Another thing you might be wondering is how is that different than just peer-to-peer lending? So peer-to-peer lending was like pre-DeFi or pre-blockchain buzz, and never really caught up. I think the reason why is because peer-to-peer lending is by definition uncollateralized, and so there's a lot of lack of monitoring and default that's going on in that space. So it doesn't work very well for that reason. So the benefits here is because you do everything on the blockchain through smart contracts, you can use some collateral assets and therefore making the scheme safer, and that's possibly some benefits here. Okay, so what are those DeFi lending platforms in practice? There are mainly three largest platforms are going to be Have, Just Lend, and Compounds. And these three combines are going to be around $10 billion of what they call total value locked. So how much has been pledged within these exchanges. And that's very large when you compare to other DeFi applications. So to think with the top three, we'll have already two DeFi lending platforms that combine are around $10 billion. Okay, so let me say more about the actual pricing mechanism, algorithmic pricing mechanism that is used over there. So the generic name, and they all are using the three platforms I mentioned, they are all using something very similar. That's typically called a protocol for loanable funds, or PLF. And that is effectively an algorithm that sets interest rate as a function of the platform's utilization rate. So the utilization rate, that's just a metric that can be instantaneously observed in the platform. So there's no Oracle problem for that one, which is the reason why they are using it. Utilization rate is simply how much of the funds have been borrowed by somebody else out of the total of funds that's available, that has been lent to the platform. So it's going to be a ratio, and that ratio is going to be typically below 1, goes up to 1. So protocol for loanable funds then going to be a function that gives you the interest rate, here the borrower interest rate, as a function f, that function can be many different things, of the utilization rate. And this is going to imply that the lender interest rate has to be the utilization rate times the function of the utilization rate. Why? Because if you have utilization rate less than 1, then there's some form of rationing. There's more people that are lending to the platform than people that are borrowing from the platform. So it means that the lender should get a less rate. They should basically share all the rates that the borrowers are taking. So that's going to be a discount on the rates for the lenders. And then on top of that, you also have some form of stability fees that needs to apply here. And I'm going to get back to that later. Okay, so something I want to mention here is that this utilization rate is already an endogenous subject to what are the decision of demand and supply in the first place. So it's not necessarily completely obvious that we are going to get an equilibrium here. It's actually a complex fixed point problem. And so if you're interested in what are the conditions that are under which you can expect to actually have an equilibrium, you can refer to the paper I have with Fahad and Fama. Okay, so what are PLFs in practice? So in practice, they're all using this very specific peculiar function, which is like a piecewise function. So here I have just taken a screenshot of the website of Compounds, where they show what's their PLF, and here in this case for Ethereum, for borrowing Ethereum and lending Ethereum. And so we don't see it very well. The PLF is the whole thing from here. So that's the utilization rate, up to here. And so we see there is a kink here. So it's like it's a piecewise linear function. There is at the beginning, there's a certain slope up to a certain threshold. And after the threshold, then they have a higher slope. And then for a given utilization, for instance, yesterday, the utilization was around 60%. Then that's going to give you how much is the borrower interest rate. Here it's like 3.16. And what is the lender interest rate? And that's lower number, and that's 1.6. Typically, the point at which this kink happens is referred as the target utilization rate. So it's kind of like a heuristic to signal that that's the point they would like to be at, but they don't want to be higher than that. And there are going to be some reasons for that I'm going to mention just a couple of slides. Okay, so let's go to the second part. I'm thinking about what's the challenges that this DeFi platform has to solve. Okay, so the first concern is going to be about efficiency. I told you there might be some efficiency gains, but there might actually be some issues coming from the fact that there's rationing in this market. You have like more people that are going to lend to the platform than people that are going to borrow. And that's because in the end, you have like this discrepancy between the two rates. So one way to visualize that, like in your Econ 101 class, you can like draw a demand and a supply for loanable funds. And then because there is now this gap between the two rates, between the borrowing rate and the lending rate, that means that in equilibrium, we are going to have an equilibrium with like the total supply is larger than total borrowing, but all these things are actually lower than what would be the auctioneer's or the first best point, which is over here. And so there's going to be a welfare loss that arises from this thing. And this welfare loss at different regions. In the next slide, I'm going to show you some quantification for the A region. The B region and the C region are more difficult to get because they need to estimate, but at least we can get a lower bound on this A region. One last point I want to mention here is that this has to be compared with banks markup. So that's the loss of efficiency from these platforms, but we know there's a lot of inefficiency that will be coming from if you're an oligopolistic competition as well, and the price setting also related to something like that. So what is the solution? If that would be the only problem here, there would be an easy solution actually. The solution would be you want to provide a PLF function with a slope as high as you can. So why is that? Well, basically, if you do that, then you're going to penalize any movements from exactly the target utilization you want. You're going to make sure that everyone always wants to be exactly there. So that would be an easy solution. We're going to see there are reasons why you don't want to do that. Okay, so that's my figure for the lower bound on the welfare loss for the different assets. And so we do it for Aave protocol V2. Aave protocol V2 has on average utilization around $1 billion during this time. It's like a lot of variation as well, just to give you an order of ideas. And then the cumulative welfare loss for all of these lending markets is around $90 million. So it's actually reasonably substantive, and that makes sense because if you look at what I showed you earlier, the utilization rate tends to be like much lower than 100%, and there's a great gap between the interest rate. Okay, so what is the problem with this infinite slope? The solution I just gave you earlier. Well, if you imagine that there is some lack of coordination or something like that, and you happen to lend to that platform that has this infinite slope, what happens is that the rate applies to all of the borrowers. So if you put money yesterday, you're going to be charged whatever is the rate that is determined today. So if you have this very large, very, very high slope, it means that the interest rate can jump from yesterday to today by, I don't know, like 1 trillion% or something like that. So you're going to be instantly wiped out. So you're facing, another way of saying that, when you are lending to this platform, you're facing some form of interest rate risk. And so if you're not purely attentive, or if you're like some form of noise traders in this platform, then that's a concern. And for that reason, you don't want to go for this infinite slope. You want to do something like some finite slope to mitigate this interest rate risk. For that reason as well, if people are somewhat inattentive, there is value creation offering some form of a fixed rate product. And that's what some of these platforms are doing, some are not. And it's exactly what the banks would do. So banks tend to lend fixed rate rather than variable rate because there is a value to avoiding this interest rate risk. But that might actually increase some potential solvency risk because somebody has to take the interest rate risk. In that case, the platform would. And that I'll get back to that as well. I'm checking the time. Okay. So the design concern number 3 is the liquidity risk. So until now, I never really discussed what's the maturity of the loan. Well, the maturity, there's no maturity to the loan. That's basically the way it works. The way it works is that you're supposed to be able to take your money out whenever you want. And that's one of the nice features about it. It's like similar to a bank because, it's bunching a lot of funds together. There's like a liquidity creation. Exactly like in a diamond digit type of model. There's like a liquidity function that this platform can create. So you can think about these as being something like a bank deposit. When you lend to the platform, that's redeemable, on demand. The issue is that what happens whenever the utilization rate goes to 1, whenever all of the funds that actually be lent to somebody else. Well, in that case, there is no fund to take back. So all of these algorithms, they feature some automatic suspension of redemption whenever the utilization rate gets to 1. So that's a source of liquidity risk for the lenders in the platform. And that might be a concern. And because it's a concern, that's the reason why you don't necessarily want to target utilization rate of 1. You want to be a little bit below. And again, like drawing some parallel with the banks have to face exactly the same type of liquidity management problem, which is the reason why they are holding some reserves. So you can think about the utilization rate gap, so 1 minus utilization rate, as being like the reserves ratio, the reserves requirement of these platforms. But there is like something else that these platforms can do that banks typically don't do, or don't do anymore, actually, to be more precise. They used to do that, which is to have secondary markets for these claims to the bank. So this would be the case with like private banknotes as we used to have, but we know that these have some problems, and maybe you can think about these other tokens or these claims on the platform that you can trade. So these A tokens, okay, as being some form of private banknotes. So you have so you can basically, if you cannot go to the platform and redeem because redemption is suspended, then what you can do is that if you can find somebody to who you can sell your A token, your claim on the platform, then you can get liquidity in that sense, in that way. All right. So the design concern number 4 is going to be some form of solvency risk. So I mentioned earlier that everything that happens on the blockchain is going to be collateralized and therefore made safe by collateralization. But that's only true to the extent that the collateral asset is itself safe. And we know that because everything is in the blockchain, you actually are going to use somewhat risky asset as collateral. And so this creates some vulnerabilities because if the value of the collateral falls at a very fast pace, then it might be that the borrowers who have some collateral claim in the platform, then won't actually have an incentive to go back and pay back because the value of the collateral falls below a certain threshold. They are better off with like never repaying and just keeping whatever the position they have. So that's an issue. So what can you do? Well, you want to create some equity or like a reserves buffer of the platform by having these retained stability fees. And that's what they do. When it gets to a certain level, then they start paying themselves dividend for these things, which is another analogy to banking. You want to ask for over collateralization. You know that collateral prices are going to move around, and so the more volatile collateral, the more you want to ask for margin, exactly as we do in banking or in any part of finance. And then the last thing that you want to have a liquidation mechanism, and that liquidation mechanism is going to be again pre-committed, pre-programmed, and automatized, so that when the value of the collateral falls below a certain threshold, then all of these collaterals are liquidated so that we can pay back. Perfect. Okay, so let me go to the last part. I want to talk about the practical usage of DeFi lending today. And here we are basically going back to this Oracle problem again, that actually you cannot really use DeFi lending to finance your house purchase. Why is that? Because your house is not available collateral on the blockchain, and it's likely not going to be anytime soon because these are like very non-standard products, and so it's going to be very difficult. So why are these useful if you cannot borrow to actually buy something that you want to buy? Well, it's actually still going to be useful. It's going to be useful in the similar way that repo is useful. So you can do repo with a lot of different assets, but these are always financial assets. And so why are people using repo? Well, they are using repo because this allows to trade between some financial institutions that want to take a leverage position. They want to take a bet on the realization of some return of some assets. They want to take some risk, whereas some other institutions like money market funds, maybe they want to be more conservative, and so they don't want to take any risk. So they actually are willing to lend, but they require collateral against that. Okay, so we have actually the same thing between within the DeFi lending or within the cryptocurrency world. That's the function that DeFi lending is today performing. So I'm going to argue here that for now it's really like a market completeness tool. Like without this DeFi lending at the beginning, you had some arbitrage that were prevailing between the different markets. The markets were incomplete, and now with this kind of products, people, if somebody wants to short or if somebody wants to take a leverage position, they can actually do it. There's a word of caution, again, like drawing from the analogy with banking. The creation of the repo or the gaining popularity of the repo market is like part of why we have seen the 2008 financial crisis. So anytime you increase or you make taking leverage easier and you basically create claim safes safe claims out of risky collateral, there's always some risk, and we can end up with like some form of leverage spirals or something like that down the line. And I don't think here we are immune to that particular type of dynamics. Okay, so going a little bit further on comparing DeFi lending to repo, actually we see that's exactly what we see today. So there's a very nice paper by Chaudhary, Kozan, and Viswanathan Natraj who documents that there is like some form of parity between the ETH, Ethereum futures, and DeFi lending rates, and that goes also to other markets. And that's really consistent with the idea that you have, whenever you have an increase in optimistic behavior, optimistic beliefs, then at the same time you're going to have more people that wants to take leverage, and so that's going to show up in the lending rates. And so there's like very good evidence that's actually happening here. I just wanted to mention somewhere, at least in the presentation, that there's something special with DeFi lending, which is these flash loans. And these flash loans are actually the way you can do this type of trades without actually having some collateral, because you do everything within the same blockchain. And so that allows you to take like extreme forms of leverage that we typically don't do. So that goes even beyond what we see in traditional finance. Okay, the last thing I want to say for this short presentation is that I think we can really use everything we know about repo in order to think about what's happening in DeFi lending. For instance, we can think a little bit about what do we think should be the benchmark equilibrium rate, interest rate on this DeFi lending platform. So if these are the same as repo, then we have like actually very good theories for that. In particular, there's more than that, but like this paper by Arvind Krishnamurthy, and then it's another paper in 2008 by Vinos and Vel, where they really think about both sides of the repo market. So there's like, most of the times, the repo market is driven by the cash side. So people want to get cash, they want to lever up. And when they want to lever up, that means they are going to be willing to pay the riskless rate for levering up. And that's the way to think about repo. But sometimes we actually also have the repo market being like collateral driven. So the reason why people want to trade in the repo market is because they want to acquire some collateral, because then they can sell that asset. And that way they can take a short position. So, and I think here we see the same thing. So we can expect like some form of specialness in some of these assets whenever they are scarce. And that's going to determine what should be the rates that we expect in these markets. For instance, what would be what do we think should be the benchmark lending rates for collateral asset, for risky security, if like everything else would be perfectly frictionless? Well, here, actually, I think we really think about it from this theory, then the benchmark lending rate for collateral should be 0. Why is that? Because the return you expect from giving the collateral is not coming from the fact that you can lend it out. If you lend it out, you still keep your exposure, which is what you want to get in the first place. So if there is no form of scarcity, we should actually expect this collateral rate to be close to 0. And actually, if we look in the data, we see something very different when you look at USDC. So this is like a stablecoin. Stablecoin is on the cash side. Because it's on the cash side, you should expect to have a positive interest rate. And that's what we see. The interest rate is always positive, and then utilization rate is actually quite high. Whereas when you think about the lending market for Bitcoin, it's actually going to be the reverse. It's going to be very low utilization rate. Why? Because everyone that's invested in Bitcoin wants to also lend it. Just get a little bit more money for that. For very little risk. You should believe in what I said earlier. So utilization rate is very low, but as a consequence of that, interest rate is also almost 0 for whenever you lend it. Okay, so that's all I have. So I just want to conclude by saying that I think DeFi lending, also DeFi in general, is like a great and growing area of research. What's really nice about it is that there are like many very practical applications, and you really get to talk to practitioners that care about the way you think. And so that's like very nice reasons to doing research in that space. The data is actually very easy to get as well, because everything's on the blockchain. What I really like as well, being a theorist, is that it forces you to think abstractly about finance. not about the current institutional settings that we have, but more like what are the fundamental forces. And then the last reason is that I still believe it's going to be like in one form or another, the future of finance. And so it's probably good to be in that space for that reason.
Thank you. Thank you, Quentin. John is going to tell us about regulation of the decentralized setting.
Okay, thanks for hanging around. So I'm Josh White. I'm from Vanderbilt University. I spent 6 years at the SEC as a financial economist, and so I'm going to assume there's no attorneys in the room. The SEC was about 95% attorneys. I am not an attorney. I'm not a lawyer, so that means I can do two things. I can say this is not legal advice, what I'm going to go through, and I can tell an attorney joke to start it off. So does anybody know the difference between God and an attorney? God does not think he's an attorney. And if you've interacted with the SEC, you know that this is something that is prominent there, that there's a lot of uncertainty that comes out of DC, both at the SEC and other commissions. So I'm going to start off by talking about some of the different operators or agencies in this space. I do want to thank Fahad and Kose for inviting me to speak, and also John Reed Stark, Hermine Wong, and Zachary Fallon, all former SEC economists that I spoke with as I was putting these together. So I'm going to start by going through the regulatory landscape. I'm going to talk about CeFi and DeFi matters, and before anybody gets upset with me, I am not taking a normative stance on any of this. I'm just trying to explain the SEC's thinking and issuers' thinking in this space. A lot of this is the arguments over, is it CeFi or DeFi? So I appreciate Fahad's definition at the beginning. And then I'll stop at the end with a crystal ball, but just know that I've been an awful prognosticator at trying to predict what takes place in DC because there's so many moving parts, but I'll give you my thoughts on that. And these slides I think will be on the website, but I'm also happy to email them to you. There'll be a lot of links that I've put in here if you want to access some of the data I'll go through. So I'm going to start talking about the four key players. The top two are civil, and so it's going to be the SEC and the CFTC, the Commodity Futures Trading Commission. Talk about a couple of the criminal agencies involved, and then there are some others. And a full caveat, the discussion is going to be U.S. focused. There's a whole slew of regulatory issues in Europe, Singapore, Hong Kong, and so just for the sake of time, I'm just going to focus on the U.S. Okay, so you probably recognize the person on the left, Gary Gensler. So he is the chair of the SEC. The SEC has 5 commissioners. The chair is by default is appointed by the president. So President Biden is a Democratic president, and so you have a Democratic chair. Hester Peirce is known as Crypto Mom, colloquially. She's a Republican, a former House staffer, and she has been very pro-crypto, or at least open to, considering the innovations spaces of cryptocurrencies. Now, a lot of questions I always get when I teach this in the classroom to MBA students is they think the SEC focuses solely on protecting investors. It's actually kind of brilliant how they put the SEC together. This came out of the Great Depression, late 1920s. People were trading stocks on pieces of paper. And so we needed some commission that could validate securities offerings and issuers. And so they actually have a trifold mission, and they can't put any of these ahead of each other. So we need to maintain orderly markets. We don't need the NASDAQ or the NYSE crashing. But the first two, protecting investors and facilitating capital formation, that means helping issuers raise capital. Okay, you can protect investors 100% by banning everything, right? There will be no fraud, but then there will be no capital formation. So every time they put out a new regulation, they have to consider, does it facilitate capital formation? Do we balance that with investor protection? Now, the two main acts that make the SEC work, again, came out of the Great Depression. The 33 Act is the Securities Act. So if you've ever done work in the IPO space, you register the securities you're going to offer. It typically registers the company at the same time on an S1. See Che is in here. He knows the S1s. Once that starts to trade in the secondary market, you have broker-dealers, you have exchanges, and they need to register under the 34 Act. So a lot of times when the SEC brings enforcement actions, it's either somebody did not register that they believe should have because they're either offering or trading a security, or there's some sort of outright fraud like a Ponzi scheme. Okay, so how do they determine what's a security? And this is really the million-dollar question in the crypto space. There's something called the Howey test that came out of a 1950 Supreme Court ruling of an orange grove. And so the Supreme Court said it is a security and therefore must be registered with the Securities Exchange Commission if it involves 1, money investment, 2, in a shared venture, 3, with the expectations of profit, and 4 from others' efforts. And so there was an orange grove, and one of the things the industry likes to point out in the crypto space is the oranges were not a security, it was the investment contract. If you're investing in this and others are going to grow the oranges and you're going to profit from it, then that makes it a security. So when we're talking about DeFi and CeFi, if we have Bitcoin, which sort of is pretty well decentralized, are you expecting to profit off of that from the actions of others? When you did initial coin offerings and there was a big wave of enforcement in 2017, those looked a lot like securities. You were issuing some token, you had an expectation of profit, others were doing the effort, and so there was a lot of enforcement in that space, and I'll go over some statistics. In 2017, the SEC realized that this is not something they could ignore. They launched a cyber unit, and so I've got some links here. You can see every enforcement action that they've ever taken at the SEC with those links. Okay, the CFTC. If it's not a security, it could be a commodity. And the current thinking is that Bitcoin is not a security and is more of a commodity. And think of a commodity like money, pork futures, things like that. All right, in that case, the CFTC has jurisdiction, and their goal is to protect against fraud and manipulation. And in 2015, they came out and said that Bitcoin and other virtual currencies are commodities under the Commodity Exchange Act. So this started what's known as a turf war in D.C. So if you're a regulator, you want someone to regulate. And the CFTC really tried hard to say these are commodities, and the SEC has tried hard to say they're securities. Industry would like to be regulated by the CFTC. It's a smaller agency. They seem to be more friendly to crypto, but not completely friendly. They definitely do not want fraud, or they don't want, we hear this hucksters and bad actors in this space. But if you are offering these financial products, you need to register with the CFTC. So there's Bitcoin futures that are traded right now. They're registered with the CFTC. All right. In 2017, they launched something very similar to the SEC. It's called Lab CFTC. They want to engage with the industry and try to integrate it into their regulatory framework. Again, you can see all of their enforcement actions. I've linked them at the bottom. Okay, those are civil. There's a criminal side. I think we can all agree that cryptocurrencies have been used for bad actions. And so the Department of Justice, who's led by the Attorney General, again, will be appointed by the President, started a market integrity and major frauds unit. And so anytime there's manipulation involving cryptocurrency, they will bring enforcement actions. And so they work in tandem with the civil units like SEC and CFTC, but also law enforcement like Homeland Security and FBI. Sample cases, a couple of these you'll probably be familiar with. U.S. versus Liechtenstein and Morgan, that was the hack of a cryptocurrency exchange. And this was a couple. The woman called herself Razzlecon. She was a amateur rapper, or the Crocodile of Wall Street. If you haven't watched any of the documentaries on that, it's interesting. And of course, they're bringing the current action against Sam Bankman-Fried, which I'll talk about here in a little bit. We also have FinCEN. That's sort of the fourth major agency I'll discuss. They're actually a bureau of the Department of Treasury. Their mission is to protect the financial system from things like money laundering, crimes like terrorism, and national security. So if there's a cryptocurrency that's being used to money launder and send money to another country that maybe we have restrictions on, then that's when FinCEN will step in. There are other important agencies. The White House put out an executive order for digital asset framework in November 2022. There's a lot of state-level enforcement, and I'll show you some enforcement statistics in a second. First thing I want to point out is this North American Securities Administrations Association. That's known as NASA. So when I went and sat on a panel at NASA, my parents were impressed, and so I told them it was, just another securities administrator. They were far less impressed. If you're only offering a token or security, if you only conducted fraud within a state, you will come under the purview of state securities agencies. And so the New York Department of Financial Services in California, Department of Financial Protection, has brought a lot of cases. It's typically because you only sold your product to residents of that state. Once you span state lines, then you will come under the purview usually of the SEC. All right, there are others, and just for the sake of time, I'm not going to go through the alphabet soup, but there's definitely a lot of other agencies that have been involved in this space. Okay, I'm going to go through some time trends. These are going to be called regulatory pronouncements. There's a lot of regulatory unclarity in this space and uncertainty. And uncertainty always leads to a lack of inaction, right? Because you don't know what the optimal choice is. We have had pronouncements over time, but these pronouncements are not necessarily new regulation. It can be things like risk alerts. It can be commissioners making speeches about what direction they think is going to go, staff guidance at the SEC. One thing you're going to see in both the pronouncements and the enforcement actions is it's very pro-crypto prices. So crypto prices peaked in 2018. That's the peak of the pronouncements. We had another peak in late 2021. Well, you see the same thing. You see another wave. All right. So by agency, the SEC has far and away put out the most crypto announcements. And a lot of that was initial coin offerings, but it's also about exchanges, also risk alerts and speeches and a lot of this turf war, followed by FinCEN and the CFTC. If you want any of this data that I'm talking about and that I will post on here, there is a attorney, a law firm called Morrison Cohen. They have a cryptocurrency litigation tracker that is phenomenal. It links to every single case, every PDF of every case. So I really think this is an unexplored area in the literature. I'm an assistant professor, so I can't really say what the literature should go in. But I do think that it would be nice to start thinking about how what the industry calls regulation by enforcement or uncertainty in this space spills over into things like the liquidity of cryptocurrencies or the prices in other areas. Okay, so enforcement actions. I'm going to keep the y-axis constant so you can see who's been the most active. Again, the SEC was really pro on enforcement, and this is, the current chair Gensler did not come until first quarter 2021. So all of this was under Clayton, which was President Trump's chair at the SEC. A lot of that first spike was initial coin offerings, which were pretty clear that those were securities. As we got into this, well, you start to see Gensler, and you can see the bars going even higher. He's been very aggressive towards cryptocurrency, and I'll talk about some of his views in a second. As we go through the other agencies, again, I'm going to keep the y-axis constant. The CFTC has been active, but not as active as the SEC. The same thing with the Department of Justice. State level, we saw a really big spike around the ICO peak in 2017 leading into 2018, and another spike more recently. So this can often be things like Ponzi schemes at the state level or state-specific offerings. Private litigation and class action lawsuits has followed a very similar pattern, but I can't hold the y-axis constant anymore. I will not use the term ambulance chasers in describing this, but oftentimes class action lawsuits and private litigation follows criminal lawsuits, and they tend to focus on securities offerings where they're backed by venture capital. The reason? Deep pockets. If you just go after Josh White issuing the Josh White token, I have no money. You're not going to get anything out of me. But if I am backed by Sequoia Capital, you can believe there will be a class action lawsuit if there's some sort of fraud. All right, putting it all together, you see again this sort of bimodal distribution around the two peaks in cryptocurrency prices. And in fact, I tried to pull this down but didn't walk through the API to get the exact prices, so I just put them on two graphs. And you can see that the spikes sort of follow total cryptocurrency prices and the spikes in enforcement action. So industry is going to call this regulation by enforcement because we don't really have a lot of new regulations, but we have a lot of enforcement actions. Okay, so let me go through some CeFi and DeFi issues. And again, what I call CeFi, industry might not think is CeFi. They may think it's DeFi. And this is sort of the argument in the SEC, is this a security or not? Ripple was the very first major case at the SEC. And this was launched in December 2020. So if you think about it, that's the very end of Jay Clayton's chair at the SEC. It's after the presidential election of 2020, and it's 1 month before Gensler comes in. All right, so Clayton sort of left this as a gift for Gensler in bringing the very first action against Ripple. And two of its executives, they argued that they raised $1.3 billion in unregistered security offering of their XRP token. And so you've probably seen discussions of Ripple as this case has been played out in the courtroom. In July of this year, the Southern District of New York, which is where a lot of the SEC cases are brought, said that the XRP was not a security in programmatic sales to retail investors. So they weren't saying it wasn't a security in all settings, but when you had programmatic sales to retail investors, they said it did not meet the third prong of the Howey test. And that was Judge Torres. All right. Something to point out in this, though, and this is where we get into that legal side. This was a summary judgment. So the SEC was trying to get a summary judgment against Ripple without ever going to court, without ever having a jury trial or anything. It got denied. About 2 weeks later, Judge Rakoff offered the opposite opinion in SEC versus Terraform Labs, and that is Do Kwon. So if you know anything about Terraform, Terra Luna, that was the exact opposite opinion. So the SEC filed something called an interlocutory appeal, which just says, Judge Torres, we think you're wrong. Go back and give us a summary judgment. Well, Judge Torres did what Judge Torres we would think would do, denied that motion. All right, so where do we stand with Ripple? Ripple is going to be one of the most prominent cases. It's probably going to set precedent, depending on how it turns out. I spoke to a former SEC attorney who is now a crypto attorney, and he told me that uncertainty reigns supreme on token offerings and token offering statuses as securities for the foreseeable future. So until this shakes out, this is probably going to have a pretty attenuating effect in the U.S. on issuing new securities or building things out on platforms that the SEC thinks is a security and not a commodity. Okay, we had one other big event, the collapse of FTX. And so Sam Bankman-Fried founded Alameda in November 2017. It was formerly at Jane Street, founded the crypto exchange FTX in May. A year and a half later, had 4 rounds of VC funding, raised almost $2 billion, had really rapid growth such that they were handling 15 billion a day in trading volume in early 2022. As we all know, it collapsed in November of 2022. The trial is ongoing. It started on October 3rd, so it's really interesting to follow right now. There's a couple great books out. Michael Lewis, Zeke Fox at Bloomberg has some great books. The allegations, which I've linked to at the bottom, include opening a fraudulent bank account, lying about what they're going to use it for, misusing customer money to fund trading in their quant fund, using customer funds to make political donations to both parties, bribery of Chinese government officials to unfreeze funds, and making false statements. One thing that Sam Bankman-Fried has not been able to do is to keep his mouth shut during this process. And so every time he has gone on like the deal book meeting and gone on TV and made these statements, they just keep adding that to the evidence file and making false statements. So I don't think attorneys would usually endorse that type of behavior. So what did FTX do besides the collapse of a major exchange? Well, it really gave Gensler this momentum to start going after the exchanges. Previously, Gensler was trying to invite the cryptocurrency exchanges in to register with the SEC. They cannot do that. The moment that they do that, they're a registered exchange with the SEC, they can only quote securities. If the SEC says all tokens are securities and not commodities, well, you're out of business. All right, so what did they initially do? They went after Kraken, their staking service, and said it was an unlawful securities offering. And again, staking is something that the blockchain uses to, if you're doing like proof of stake work, things like Ethereum, it helps you verify transactions. And if you stake your currency, so you hold some Ethereum and then stake that, you can earn a return on that. Well, Kraken suspended its program and paid a $30 million fine. So Kraken did not fight, but when they immediately brought cases in June of 2023 and July against Coinbase and Binance, both of these are fighting. So CZ is trying to fight from Binance. Brian Armstrong, Paul Gould, the chief legal officer at Coinbase, says they're really going to fight the SEC's case. Coinbase, they say, well, it's an unregistered national securities exchange, broker, and clearinghouse. They also have a crypto staking service, which they're saying is an unregistered offering. Binance has 13 charges, and they're trying to freeze some of those funds. It's been really interesting. Coinbase is a public company. They went public through a direct listing about 3 weeks before Gensler took the office at the SEC. Binance is not. This is a foreign entity that's not registered in the U.S. Coinbase is audited. Thank you. Coinbase is audited. Binance is not. CZ went on CNBC and said it was impossible to audit cryptocurrency exchanges. So this will be some of the fun things that sort of play out in that space. So this is CeFi because you're relying on these exchanges to handle your money. All right, DeFi. What is the challenge for regulators? Well, the ability to regulate anyone is you have to know the person's identity and their activities. And it's by design, DeFi platforms operate without a central authority. That is the allure of crypto or the blockchain, right? So if there's a topic of concern in the DeFi space, there may not be a clear person or entity the SEC can bring actions against. So this often scares regulators because if there's fraud or manipulation, who do we go after? I'm glad Joel brought up the Uniswap example. So Uniswap had a class action lawsuit, and the SDNY judge ruled that scam token issuers, not Uniswap, are liable for investor losses. So the issuers lost money on these scam tokens, and they sued Uniswap because, again, they have deep pockets, and they didn't know who issued the scam tokens. And so the judge said, it was devoid of factual evidence, which sounded more like a referee, but that the exchange is not liable simply because the plaintiff cannot identify the sponsor. All right, Bitcoin and Ether. The former SEC Director of Corporation Finance, Bill Hinman, gave a speech in 2018 saying, based on my understanding, the present state of Ether, current offers and sales of Ether are not securities transactions. All right, so there was a thinking that Bitcoin and Ethereum, or Ether, would be cryptocurrencies that are not securities. Yet now, Bitcoin is the only cryptocurrency that under Chair Gensler that they will say is not a security. And in fact, I've linked it at the bottom, a video of Chair Gensler in 2018 in a talk to hedge funds, named 4 tokens and said, why did I name these tokens, including Ether? Because they're not securities. And so he's clearly changed his mind on that fact, because since becoming chair in 2021, he has not made it clear that Ether is or is not a security. And in fact, when he was grilled by the Senate Banking Committee and the House Financial Services Committee this summer, he declined to answer that question. So that's where a lot of the uncertainty comes from. All right, the last thing I'll talk about for DeFi, and then I'll try to give some predictions and wrap up, is a Bitcoin ETF. So many sponsors have tried, all have failed to form a Bitcoin ETF. Grayscale has probably come the closest. So it's currently, they're holding Bitcoin in a trust. It's traded over the counter because it's not a registered security. They won a ruling in the DC Court of Appeals in August. The SEC was trying to say, look, there's inadequate fraud surveillance on Bitcoin platforms. Grayscale countered and said, look, our Bitcoin ETF and the Bitcoin futures, which you've already approved that trade, have a 98% correlation. So why would you deny us but not deny these others? And the SEC returned and said, well, correlation is not causation. And I'm not the endogeneity police, but 98% is pretty close. So the court ruled against this. I had to put these slides together before last night. The SEC had to last night at midnight to appeal. They declined to appeal this. That does not mean we're going to have a Grayscale ETF next week, because they can deny it on other means. BlackRock, Fidelity also have an application. I've seen some predictions that if the SEC approves it, they'll approve all at the same time so that you don't have a first mover advantage. Okay, so I'll wrap up with a crypto crystal ball. We all saw the tragic things that happened in the Middle East recently. I think this could have a profound impact because of a bipartisan bill that's been floated around in DC before this took place. So a Wall Street Journal article came out last week saying 3 militant groups had raised $130 million to fund their activities. And this was the graph that they put out, although you can see at the end they stopped using that, maybe when they got wind that they were potentially being tracked. So laws could be written to ensure that transactions comply with anti-money laundering and combating financial terrorism. So remember, this was FinCEN. I really think this would be one of the first things that happen. The reason why, there is a bipartisan Digital Asset Anti-Money Laundering Act that includes Elizabeth Warren, Joe Manchin, and then also 2 Republicans that would do things like include digital assets in the Bank Secrecy Act, instruct FinCEN to provide guidance and look at who's taking out money from kiosks in Bitcoin. Also requiring U.S. investors to report to the IRS if you have more than 10,000 in digital assets. So this could take away some of the allure, right, of cryptocurrency and the privacy notion, but this would be something that would work towards anti-money laundering and funding terrorism. All right, the House Financial Services Committee, who is led by Republicans right now, they oversee the SEC along with the Senate Banking Committee. They drafted 3 bills this summer, 2 of which were crypto-specific. So the Clarity for Payment Stablecoins Act is really what I thought would be first coming out of the Biden executive order, and that is putting some guardrails in place, putting some audits in place for stablecoins. Not algorithmic stablecoins, but actually stablecoins backed by fiat. The Keep Your Coins Act that they're proposing right now is requiring all exchanges to allow customers to self-custody their coins, so that if FTX collapses, you don't lose your crypto. You can trade with FTX, but then self-custody. This last one is just that companies, issuers, even token issuers, only have to disclose material information, so it's a little less crypto-specific. Before I go to my last slide, it's unlikely that this would pass through a Democratic-controlled Senate. It's really unlikely that this would make it past Biden's desk without being vetoed. So this is probably being set up for this next election cycle, which sets up my last slide. And that is, everything in crypto is going to depend on this next election cycle in terms of regulation. I'm going to assume Biden and Trump are the two candidates. Again, I'm not going to make a forecast. I'm taking this solely on current surveys. It's clear that Biden is not a crypto cheerleader, and his advisors are really split on the role of crypto. Even though they put out that executive order, it was really calling for more studies. You might see a bill like the Elizabeth Warren bill tacked on to a larger one. But I don't think we're going to see something that's really pro-crypto in terms of new regulations coming out of Biden. For Trump is also not a crypto cheerleader, even though he had his own NFT, and his Treasury Secretary, Mnuchin, could not stand crypto, thought it was used purely for fraud. So I think only if his base pushes for crypto will we see Trump's presidency, if he was to get elected again, be pro-crypto. The one thing that would change is if the Republicans take the White House, Senate, and keep the House, then some of those House bills could get through. But more than anything, if a Republican takes the White House, regardless if it's Trump, then Gary Gensler is going to be replaced with a Republican chair, so you can think that it'll probably be less heavy-handed on enforcement and more maybe open to industry.